Welcome to the Retiring Club. My name is John, and I will be your host for this meeting. And I'm so glad that you're here with me. We have picked up a couple, three new subscribers, so I'm on my way to 100. And I want to welcome everybody here. Just to give you a heads up and bring you up to date, the Retiring Club, I started this because we just didn't have one in the area that I live in. And I wanted to have something that would have a library that people could watch the videos and learn a little bit about investing, specifically how to look at investments, how to look at the top 10 holdings, how to look at the history of the investments, and as far as when they were started and how long they've done and over the years so that you can track the gains in them. And I think we've been doing a pretty good job. We also showed how to open up an account with Fidelity, fund it, and then make a purchase, as well as we've talked about some of the withdrawal strategies and things like that in the series, as well as budgeting. So I just wanted to tell everybody I'm glad you're here. And continuing with the series that I started a couple of videos ago about you as a portfolio manager, one of the things that portfolio managers do is they do have turnover in the investments. And the turnover in the investment starts typically with what I call a watch list. You look at the time horizon when you purchased the investment, what you paid for it, and how long you've held it, what the yield is, which is usually the capital gains that are paid out in December and sometimes earlier in the summer, which is your short term capital gains, as well as your long term capital gains in the dividends. So you look at that and you see how much that's paying, and you look at the price that you paid for the investment and is it appreciation? Is it going up in value? Or is it headed down south where it's taking a tank where you're about to lose some of the money that you put in? So that's what we're going to be covering in this meeting of the Retiring Club. Again, my name is John, and we are um, talking about investment turnover and you as a portfolio manager. Once you invest in a mutual fund or you buy a stock in you doing it online yourself, or even when you pick it inside of your 401k, um, you're basically making the decision to make that investment with the intention of it growing by compounding the gains and appreciating in its value. When it doesn't do that, sometimes it's best to liquidate the position and then get something else. And that's what we're going to do here. I picked out an investment of my own that we're going to take a look at and the purchase price of it first. I just want you to see how much I paid for it, how much it grew, and how much it fell. And then we should have it all on the time horizon. And then we're going to look at it today and what it's valued at today. And then you'll understand why you want to keep an eye on these investments. And when you're doing this, you can use something which is called a watch list that Yahoo Finance has, and most of the um, online brokerage accounts have, where you go in, it's a watch list, you put the ticker symbol in, and then at a glance, you can always see where it is. So if it was falling and you wanted to have what they call a stop in price, where you don't want to let it go lower, you would see that. In the mutual funds, it's not the same as with stocks. You kind of have to get in and know when this is happening, as well as when you're looking to take some gains out of it. Say you need a couple $1,000, it's grown by 12 grand, and you just want to make sure you're doing it at the right time to maximize the investment. So last week, the jobs report came out and the market dropped about close to 2%. And today it's back up about 1.5%. So the accounts are looking pretty good, but we want to keep an eye out on how the information that comes out from the feds and the job reports affect it. Once we start hearing that there's a bunch more jobs or the Fed cuts rates, you know that your investments are going to do well. And that's when you want to keep an eye on, especially if you need to have some money on hand in case you're retiring early or if you lost your job. Um, because there are some benefits for you taking out a chunk of money once you lose your job, because you get a standard deduction and most of the taxes have already been taken out. You're even bored on the taxes, and then if you're going to be short a few $1,000s and you don't know how long it's going to take, you may want to exercise the option of selling some of these shares, have them in the money market so you can withdraw them. So this is what we're going to get into. I'm going to hop into it right now and come back with a screen share. Thank you. Okay, so we're back. So the investment that I picked out was Fidelity Select IT Services Portfolio. I was trying to get more into technologies, and I found these symbol is FBSOX. I purchased this. This came in as cash from employer that I left in the 401k. Trump was in office. He was doing all kinds of stuff. The stock market was rallying. So I kind of held on as it was going through those multiple days of rallying, and then I finally pulled the trigger on it. And I bought over about $33 to $35,000. Where had I did it as soon as I left, I would only have 30 grand. But I made this purchase of this technology fund at the in towards the in June here, settled on the 26th. This is a statement from the end of July is what it's saying. So that's the value, 6,061, 8480.854 shares. So that matches. Now the price has gone up. You can see the price going up in the value. So I made $52. And this is the initial investment of $6,000. And as you can see, I have these statements. I keep them in a binder. So if I have an investment, I'm wondering what went wrong, I'll go back and I'll pull all that paperwork and I'll look at it. So this is the heyday of it. Now, fast forward into the future to December 1st, 2021. You can see that I got 8,267 is the value of the account. The quantity of share is now 105. I never put any more money in it. It was reinvesting the capital gains, which is short term and long term, and the dividends. And what they do is they'll buy more shares, and when it pays out, the value of the dollar price goes down a little bit, and it's like you're getting the shares at a discount. Now the $70, it's up to 82. So that's a $12 gain on the investment. And its ending value is 8,007. Now here's the gain right there. $2,758.90. And let's see, we've had that maybe a year and a half. Okay. So what happened was I kept an eye on this account, and then eventually I sold it. And so here we go. We're selling it. You can see some more capital gains came in. That's 118 shares. You got 105 here. April of 2022. Now, Russia had invaded Ukraine, and that sent the year 2022 in a spiral downhill. And what I did with this investment, I kept my eye on it because it did so well, and it seemed like it had doubled. Somehow I thought this doubled. Maybe it was another one, but I kept watching it, and I said, you know what? This thing's headed in the wrong direction. Look at it. It's below 7,000 where it was up to 8,200. So what I did was I went and sold, and I sold it after it paid out its capital gains. So it paid out capital gains, and that's probably how I have 118 shares, and it generates $6,990. So this is the turnover that I did in this account as myself managing it by keeping an eye on my investments. That's why some people look at it once or twice a week. They can track this stuff, but they also can put it on the watch list. And then you can, if there's a trigger point where you want to sell on a mutual fund, you have to watch it. Now on a stock, there's all types of uh, options to sell it as it drops. If you don't want to hold on something that's losing 10% and let it go to 20, it'll sell at a 10% loss, and then you get your cash back and go do something else with it. Those are the stop losses and things, but I don't want to get into that because I don't do that day trading or use that type of account anymore. So I took that money and I moved it over here, and I bought the Fidelity Magellan, and I bought that at $20.65. That's the 6,000 that came over. Now, be mindful, I took $1,000 out of this account last week, and it's still showing 69.34% gain and 4,372 for a total of $10,000. It's trading at 34.97. This was a good investment. This is an example of a portfolio turnover. In my case, I salvaged this. And what we're going to do is we're going to stop, and I'm going to come back on and I'm going to show you about this FBSOX, what it's trading at today, what's in it, and you can be like, man, you dodged the bullet. And this will be a very, very good example of portfolio turnover. Because as a someone who is early retirement, planning retirement, or in retirement, you got to kind of keep track of this stuff. Your portfolio, if you got an investment advisor, maybe they'll call you and say, hey, it's time to do something else with this. But if they don't and your account goes negative like that, then why are you paying them? But anyway, I'm going to come back to this and we're going to take another look. So let's look again. You took the 6,090 from selling and you put it in Magellan over here. Remember, I took $1,000 out. And this is with the reinvestment. And this is mostly appreciation. Look at 34. That's nearly $15 a share. Well, let's say 14 in the growth. So I picked the good. That's the only ETF I have. So we're going to come back and look at FBSOX and talk about it a little bit more. Okay, over at Yahoo Finance, and we're just going to get all your news over here, but let's take a look what you can see over here on the right hand side. This is some of the stocks or the mutual funds that I'm looking at right now. And what we're going to do is let's get in here. And so we're going to bring this investment up. Remember, I bought it at $70 in 2019, and this is what it's trading at right now, $53.18. So this thing would have been a loss leader, and my account would have been negative. It's right down here. And then you can see, we're only going to spend a hot minute on this because this is just an example of how you could lose some money if you don't keep an eye on it. It's talking about a 1-year return. I don't believe that unless it paid out a lot of dividends or something. But let's see the companies that are in here. Visa, MasterCard, IBM, Accenture. See, I don't like any of these companies really. Oka, that's two-factor authentication. Technology, they're in financial services. So you can see why this thing has been down for a while. So we go back and look at it over the 5-year period, and this is when I owned it. I bought it back, see, in 2021. This thing has been down. It was just a disaster waiting to happen, and I got rid of it. Right about there. So it was way up here, 36, and I sold it about here. This was like almost the same day, the 22nd or something of June, and it stayed low since that. If we go out 10 years, you can see that it was peaked out here, 628. That's showing $30.38. Yeah, so this was a loss leader. So when you look at this baby here, you can see that this is something that you would have not held on. I mean, other than it reinvesting the capital gains, there was no appreciation in it. Whereas over at the Magellan, I got 69% out of that. Plus, I got $1,000 put in the money market. So this is it. Again, if you're looking at anything, the Yahoo, I'm just going to wrap this up because I don't want this to be too long. But this is an example of portfolio turnover, and I hope you enjoyed it. Again, my name is John, and we're putting this together to help us build our financial independence and keep ourselves on track to keep some of our money for when we need it. And we got a lot more to go. There's going to be a whole lot more I'm going to be doing with these accounts going in the future. Okay. My name is John, and I'm going to end this meeting. Go ahead and subscribe and like because I'm putting out some more stuff and coming up probably in a week. Thank you.